There is a financial system operating in the background of every economy on Earth, one that determines what currency countries hold in reserve, why oil is priced the way it is, and how entire nations can be cut off from global trade with a single policy decision. Most people have never heard of it. Most economics textbooks do not explain how it was actually built or what it actually does. It is called the Petrodollar System. And by the end of this video, you will understand exactly how it was constructed, how it works at every mechanical level, and what the current geopolitical discussions around it actually mean in structural terms. This is not a surface-level overview. This is a complete, chapter-by-chapter breakdown from the historical origins in 1944 all the way through to the Saudi Arabia and China developments that are generating headlines right now. We are going to cover the origins, the full mechanics, the OPEC dimension, the geopolitical consequences, and an honest analysis of where things stand. Let's get into it. One framing note before we go deep. Everything in this video is analysis based on historically verified events and publicly available data. This is not a political argument. It is a structural one. And this is not financial advice. It is financial education. Every claim in this video is traceable to a specific historical event, a confirmed data source, or an established institutional record. To understand why the petrodollar system exists, you need to start with one observation about oil, one that most people systematically underestimate. When most people hear the word oil, they think about fuel, petrol at the pump, diesel for trucks, jet fuel for planes. That is accurate, but it is a fraction of the actual picture. Oil is not just an energy commodity in the modern global economy. It is the foundational input cost for virtually every physical product manufactured and traded on Earth. Let me be specific about exactly what that means. The plastic casing on virtually every consumer product, bottles, electronics housings, medical equipment, packaging, is derived from petrochemicals, which come from crude oil. Synthetic fibers used in clothing and industrial textiles are petroleum-based materials. The fertilizers that grow the food on supermarket shelves globally are manufactured using oil and natural gas as primary feedstocks. Pesticides, industrial chemicals, pharmaceutical manufacturing inputs, paint, adhesives, all of these use petroleum-derived components at some stage of production. In large parts of the developing world, oil and oil-derived fuels remain the primary source of electricity generation. And here is the point that matters most for everything that follows in this video. As of now, the vast majority of physical products that cross an international border move in ships, planes, and trucks that run on oil. Global trade itself, at the physical level, runs on oil. Think about what that actually means in practice. If oil prices increase significantly, the cost of manufacturing rises because input costs rise. The cost of transporting goods rises because fuel costs rise. The cost of agricultural production rises because fertilizer and machinery fuel costs rise. The cost of electricity generation rises in oil-dependent economies. All of these cost increases happen simultaneously across every economy on Earth, driven by the movement of a single commodity's price. This is why the global oil market is not simply an energy market. It is the primary cost determinant for the global economy as a whole. In my view, the most underappreciated fact about oil is that it functions not primarily as an energy source in the modern economy, but as the foundational cost base for virtually every physical product on Earth. That distinction is the reason everything that follows in this video matters. Now, because oil is this important, countries around the world are in constant, large-scale commerce around it. Some nations produce oil in quantities that far exceed their domestic needs. Saudi Arabia, Russia, the United Arab Emirates, Iraq, Kuwait, Nigeria, and others. Other nations consume large quantities of oil, but produce very little domestically. Japan, Germany, South Korea, most of Europe, and large portions of Asia. This creates a massive global flow of oil across national borders, denominated and priced in a specific currency. And that currency is the US dollar. Not the euro, not the British pound, not the Chinese yuan, not a basket of currencies. The US dollar specifically. Why? That is the question this entire video answers. And here is where it gets genuinely interesting, because the answer requires going back to 1944, walking through a specific sequence of historical decisions and understanding exactly how this arrangement was built. So that is where we start. And if you think the origin story is the most interesting part of this video, wait until we get to the Geopolitics chapter, where we break down exactly how the petrodollar architecture gives one country the ability to cut another country off from global commerce without deploying a single soldier. That section changes how you read every major sanctions headline you will ever see. To understand why the petrodollar system was created in 1973, you need to understand the financial architecture that existed before it, and why that architecture was under severe structural pressure by the late 1960s. The story begins in July 1944 at the Mount Washington Hotel in Bretton Woods, New Hampshire. World War II was still being fought in both Europe and the Pacific, but the Allied nations already understood the war was approaching its conclusion, and the most consequential economic question of the post-war period was on the table. The question was direct. What would the international financial system look like after the war ended? To understand the significance of that question, you need to understand the state of the world's major economies in 1944. Germany's industrial base had been severely damaged by years of Allied bombing campaigns. France had been under military occupation for 4 years, and its economy was in disarray. The United Kingdom had accumulated enormous war debts and was in the process of losing its position as the world's leading economic power. Japan was still fighting, but its industrial capacity was being systematically destroyed by US air campaigns across the Pacific. The Soviet Union had lost an estimated 20 to 27 million people during the war, and had its Western industrial and agricultural infrastructure devastated. The United States, in contrast, stood in a position of extraordinary economic concentration in 1944. U.S. manufacturing capacity had expanded massively during the war years to supply both domestic military needs and Allied forces. The United States had become the world's largest creditor nation, having provided substantial financial support to Allied governments throughout the war. And the United States controlled approximately 55% of the world's total monetary gold reserves, a concentration of gold ownership that no other nation came close to matching at that time. 44 nations sent representatives to Bretton Woods in July 1944, and the conference ran for 3 weeks. The outcome of that conference established the international financial architecture that the world has operated under, in modified forms, ever since. The core decisions made at Bretton Woods were the following. The US dollar would serve as the world's primary reserve currency, the currency in which international transactions would predominantly be settled, and in which nations would hold their foreign exchange reserves. Second, participating nations would peg their own currencies to the US dollar at fixed exchange rates. Third, and this is the foundational element, the US dollar itself would be pegged to gold at a fixed rate of $35 per troy ounce, and any foreign government or central bank could exchange their dollar holdings for physical gold at that rate on demand. This meant that the US dollar was, for all practical purposes, a direct claim on physical gold stored in US government vaults. Any country holding dollars was effectively holding a substitute for gold, with the additional convenience of being a currency usable for commercial transactions, rather than just stored as a reserve asset. 2 major international institutions were created at Bretton Woods to support this new architecture. The International Monetary Fund, to oversee international monetary cooperation and provide financial support to countries facing balance of payments difficulties, and the World Bank, to provide long-term development financing. Under this system, international trade expanded significantly through the late 1940s and into the 1950s. Fixed exchange rates gave businesses and governments conducting cross-border commerce a predictable pricing environment. The dollar's gold backing gave every country holding dollars confidence in the currency's underlying stability. And the United States, as the issuer of the reserve currency, sat at the architectural center of the global financial system. But here is what most accounts of the Bretton Woods era do not explain clearly. The system had a fundamental structural contradiction built into its design from the very beginning. That contradiction was identified and formally described by a Belgian-American economist named Robert Triffin in 1960. It became known as the Triffin dilemma, and understanding it is essential to understanding why the petrodollar system was eventually necessary. The dilemma works like this. For the Bretton Woods system to function, the rest of the world needed a constantly growing supply of US dollars to use as reserves and for international trade settlement. Global trade was expanding every year through the 1950s and 1960s, which meant the world needed progressively more dollars to finance that expanding trade. But the only way for the United States to supply a constantly growing volume of dollars to the rest of the world was to run persistent trade deficits, to continuously import more goods and services than it exported. When the US imports more than it exports, dollars flow out of the US economy and into foreign hands, which is precisely what the world needed in order to accumulate dollar reserves. But here is the contradiction. Under the Bretton Woods rules, every dollar held by a foreign government was a potential claim on US gold reserves at the fixed rate of $35 per ounce. So the more dollars the US supplied to the world by running trade deficits, the larger the pool of potential gold claims against US Treasury reserves became. And the more gold the US paid out to honor those claims, the thinner its gold reserve cushion became, which progressively weakened its ability to honor the gold convertibility commitment that gave the dollar its credibility in the first place. This was not a theoretical risk. It was a mathematical trajectory playing out in visible data across the late 1950s and 1960s. US government spending commitments during this period were substantial. The Korean War, the Vietnam War, the Cold War military buildup, and domestic social programs all required significant expenditure. All of this spending created large quantities of dollars flowing into the global economy, and foreign central banks were tracking the ratio of US gold reserves to outstanding dollar obligations with increasing concern. By the mid to late 1960s, foreign dollar claims were running significantly ahead of the US gold reserves available to back them. France, under President Charles de Gaulle, was particularly aggressive in its response. De Gaulle publicly questioned the legitimacy of the dollar's reserve currency status and directed the French central bank to systematically convert France's dollar holdings into physical gold, dispatching ships to collect that gold from US Federal Reserve vaults. Other European nations pursued similar policies to varying degrees. The mathematics were becoming unsustainable. The United States could not simultaneously supply the world with the dollars it needed for global trade and maintain sufficient gold reserves to honor the convertibility commitment. Something had to give. What gave was the gold convertibility commitment itself. On the evening of Sunday, August 15, 1971, President Richard Nixon appeared on U.S. national television and made an announcement that sent immediate shock through international financial markets. Nixon announced, unilaterally and without any advance consultation with foreign governments, that the United States was immediately and indefinitely suspending the convertibility of US dollars into gold. Effective immediately, foreign central banks could no longer exchange their dollar reserves for gold at the US Treasury. The foundational commitment that had underpinned the entire Bretton Woods system since 1944, the gold peg that made the dollar credible as a global reserve currency, was severed in a single televised address. This became known as the Nixon shock. The name is accurate. International currency markets went into significant turmoil in the days that followed. The fixed exchange rate regime Bretton Woods had maintained since 1944 began to collapse, with major currencies floating against each other for the first time in decades. The Bretton Woods system, as originally designed and operated, effectively ceased to function after August 1971. And the critical question now facing the United States and the global financial system was this: if the dollar is no longer backed by gold, what gives it its value? Why would any country choose to hold US dollars as a reserve currency if those dollars were not convertible to gold? What structural mechanism would sustain global demand for the dollar going forward? In August 1971, there was no clear answer to that question. The answer came from an unexpected direction, and it came from a crisis that erupted in the Middle East 2 years later. Nobody talks about this part. On October 6, 1973, Egyptian and Syrian military forces launched a coordinated surprise attack on Israel. Egypt crossed the Suez Canal into the Israeli-held Sinai Peninsula. Syria attacked simultaneously on the Golan Heights. Israel, caught off guard on Yom Kippur, the holiest day of the Jewish calendar, suffered significant initial military losses before fully mobilizing. The United States provided emergency military resupply to Israel during the conflict, airlifting equipment and materiel to support the Israeli military effort. The Arab members of OPEC responded to the U.S. military support for Israel with a direct economic action. On October 17, 1973, the Arab OPEC members announced an oil embargo, a complete halt to oil exports to the United States and to other countries they identified as supportive of Israel, including the Netherlands and others. What happened to oil prices in the months that followed was severe. Before the embargo, crude oil was trading at approximately $3 per barrel on the global market. By early 1974, at the peak of the crisis, crude oil had reached approximately $12 per barrel, a price increase of roughly 300% in a matter of months. The effects on Western economies were immediate and widespread. Long queues formed at petrol stations across the United States as fuel supplies tightened. The U.S. government introduced a national speed limit of 55 miles per hour as an energy conservation measure. This year-round daylight saving time was introduced in the United States to reduce electricity consumption. Several European governments banned private car use on specific days of the week to reduce fuel demand. Inflation across Western economies spiked. Because oil is the foundational cost input for manufacturing, transportation, agriculture, and electricity, as we established earlier, price increases in oil cascaded through every sector simultaneously. The 1973 oil crisis was one of the clearest demonstrations in modern economic history of how dependent the Western economic model was on accessible, affordable oil, and how vulnerable it was to supply decisions made by oil-producing nations. For the United States government, the crisis exposed two simultaneous and urgent vulnerabilities. Vulnerability 1, the energy exposure. The U.S. economy was demonstrably vulnerable to oil supply disruptions controlled entirely by foreign governments. Vulnerability 2, the dollar problem. The dollar had been severed from gold 2 years earlier and still had no clear foundational anchor for sustaining global demand. These two vulnerabilities intersected in the thinking of one man in particular, Henry Kissinger, serving as U.S. Secretary of State under President Nixon. Kissinger understood, through his analytical framework for geopolitical strategy, that the United States and Saudi Arabia had a specific alignment of interests that could be structured into a formal arrangement addressing both vulnerabilities simultaneously. Saudi Arabia, as the world's largest oil producer and the most influential voice within OPEC, held a position that made it uniquely significant to U.S. strategic interests. Let's be precise about what each side needed from such an arrangement. Saudi Arabia in the early 1970s faced genuine security concerns. The kingdom's geographic position in a volatile region, with regional rivals and potential threats from neighboring states, created real security requirements that demanded credible deterrence. Saudi Arabia needed a military protector with the capability to provide advanced weapon systems, intelligence support, and a security commitment that would deter hostile action. It also needed a stable, large-scale framework for managing the enormous dollar revenues it was accumulating from oil sales, a financial infrastructure with the depth and legal protections to hold and invest hundreds of billions of dollars productively. And it needed political legitimacy and diplomatic support in international forums, which U.S. backing could provide. The United States, for its part, needed two things specifically. First, a reliable long-term framework for oil supply access that would reduce the energy vulnerability the 1973 crisis had so clearly exposed. Second, and this is the more fundamental point for our analysis, a new structural mechanism that would create constant global demand for the US dollar as a replacement for the gold convertibility anchor severed in 1971. The logic was direct. If oil, the commodity every country on Earth required to run its economy, was priced and sold in US dollars, then every country on Earth would need to acquire and hold US dollars as a matter of operational necessity. That would create a structural demand anchor for the dollar that no gold peg could have provided, because gold supplies are finite and global energy demand is continuous. The negotiations between the US government and Saudi Arabia, conducted through Kissinger and senior officials on both sides, produced an arrangement implemented across 1973 and 1974. The core terms were the following. Saudi Arabia would price and sell its oil in US dollars. The dollar revenues Saudi Arabia accumulated from oil sales would be invested primarily in US Treasury bonds and other US financial assets. The United States would provide Saudi Arabia with military equipment, security guarantees, and political support. A formal Joint Economic Cooperation Commission between the two governments was established to institutionalize the relationship. Following Saudi Arabia's lead, other major OPEC producers implemented comparable dollar pricing arrangements. Cause Saudi Arabia's production volume and influence within OPEC were substantial. Its adoption of dollar pricing functioned as a precedent that the other major producers progressively followed. The result? Any country anywhere on Earth that wanted to purchase oil from the major OPEC producers was now required to first acquire US dollars. Not their own currency, not a neutral basket of currencies, US dollars specifically. The Petrodollar System was operational. In my view, the 1973 arrangement is analytically interesting precisely because it was a rational transaction between two sovereign actors, not an act of imposition or domination. Saudi Arabia received exactly what it needed: military protection, investment infrastructure for its oil revenues, and international political support. The United States received exactly what it needed: energy supply security and a foundational anchor for global dollar demand to replace the gold standard abandoned 2 years earlier. What neither party could have fully anticipated in 1973 was the scale of structural advantage this arrangement would confer on the United States over every other economy on Earth across the following 50 years. That is often the pattern with the most consequential arrangements in financial history. The full implications become visible only over decades, not at signing. Here is what most people miss when they encounter this history. The 1973 arrangement was not a concealed conspiracy between hidden actors. It was a negotiated exchange of interests between two sovereign governments, each pursuing what was rationally in their national interest at a moment of significant geopolitical pressure. Understanding the transaction logic of how it was built matters, because it determines how you think about whether and how it might change. Systems built on rational self-interest persist as long as that self-interest calculus remains in place for the key participants, and they begin to shift when the calculus changes. Keep that framework in mind as we go into the mechanics and then the geopolitical developments. Before we go into the full mechanics of how the petrodollar system operates, the recycling loops, the structural dollar advantages, the OPEC dynamics, the sanctions architecture, I want to take 20 seconds. I made a complete course titled Applied Macroeconomics. It covers the full architecture of the global monetary system in a structured, module-by-module curriculum. This video covers the petrodollar system specifically. The course covers the complete picture: central banking, sovereign debt, trade theory, monetary architecture, economic cycles, and more across 10 modules. Total course video content is over 2 hours, intentionally stripped of all filler. Every minute is there because it adds value. Email support is included, so any questions you have while working through the material can be addressed directly. The link is in the description below. Now, back to the petrodollar system. Here is exactly how the machine works. The arrangement established in 1973 did not simply create a pricing convention for oil. It created a self-reinforcing feedback loop, a mechanical system that continuously regenerates the conditions required for its own persistence. Understanding this loop at a precise mechanical level is what separates a surface understanding of the petrodollar from a genuine one. So let's build it from the ground up, one component at a time. Start with the foundational rule the 1973 arrangement established. Oil from the major OPEC producers is priced and sold in US dollars. Now apply that rule to a country like Japan. Japan is among the world's largest economies by nominal output, and it imports almost all of the oil it consumes domestically. Its domestic oil production is negligible relative to its consumption requirements. To run its manufacturing sector, its transportation infrastructure, its electricity generation in oil-dependent facilities, and to produce the petrochemical inputs for its industrial base, Japan needs oil, constantly, in large volumes. To purchase that oil from major OPEC producers, Japan needs to pay in US dollars. Japan's domestic currency is the yen. Japan's government collects taxes in yen. Japan's businesses earn revenues predominantly in yen. To convert yen into the dollars required to purchase oil, Japan must participate in foreign exchange markets, selling yen and buying dollars. This creates a structural, continuous demand for US dollars from the Japanese economy, not because Japan has chosen to favor the dollar, but because the commodity Japan must import to run its economy is priced in dollars. Japan is one country. Apply this same logic to South Korea, Germany, India, France, Turkey, Thailand, and every other major oil importing economy on Earth. Every one of these economies is generating structural, continuous demand for US dollars simply by maintaining their economic operations, because every one of them needs oil, and oil is priced in dollars. And here is what most people miss about the scale of this effect. This is not demand driven by investment preference. It is not demand driven by confidence in US economic management. It is not demand driven by political alignment with the United States. It is demand driven by operational necessity, by the basic requirement of running a modern economy. That distinction matters enormously when you think about the dollar's structural position in the global financial system. Most reserve currencies in history derived their status from the economic and military power of the issuing nation. When that power declined, the currency's reserve status declined with it. The petrodollar system added a second, independent source of dollar demand, one rooted not in perceptions of US power, but in the operational requirements of every oil-importing economy. This is the architectural foundation. Now let's build the 3 structural advantages it created for the United States. Structural Advantage 1: persistent support for dollar value. In currency markets, like all markets, sustained demand for an asset supports its price. The constant, operationally driven global demand for US dollars, created by petrodollar pricing, provides a persistent floor of support for dollar value that no other currency possesses. When the US economy faces difficulties, rising debt, political instability, poor economic data, Normal market logic would suggest the dollar should weaken significantly, as other currencies do under comparable domestic pressures. The petrodollar demand floor means the dollar has a structural support mechanism partially independent of U.S. economic conditions. Every day that oil trades in dollars is another day of structural support for the dollar's value relative to all other currencies. Structural advantage 2. Persistently low borrowing costs for the U.S. government. This is the advantage that most mainstream analysis consistently underweights, and the data on this is extraordinary. When foreign governments and central banks accumulate large dollar reserves because they need dollars for oil purchases, they need to put those dollars somewhere. The instrument they predominantly choose is U.S. Treasury bonds, securities issued by the U.S. government, denominated in dollars, offering interest payments and ultimate repayment in dollars. U.S. Treasuries offer a combination of characteristics that no other sovereign bond market can match at the required scale. The deepest and most liquid bond market on Earth, strong legal protections under U.S. law, and dollar denomination, the same currency the reserves are already held in. The result of this constant, large-scale demand for U.S. Treasuries from foreign central banks and sovereign wealth funds is that the U.S. government can borrow money at lower interest rates than would otherwise be warranted by the scale of its debt obligations. When there is a persistent, large-scale buyer for your bonds, regardless of the price, your borrowing costs are structurally suppressed. No other government on Earth has access to this mechanism. Germany, Japan, the United Kingdom, France, all sophisticated economies with strong institutional frameworks, must borrow at interest rates that more directly reflect market assessments of their fiscal positions. The United States borrows with a structural buyer in the market that no fiscal analysis fully explains, because the buyer is there for operational reasons, not because of a judgment about U.S. creditworthiness. The compounding effect of this over decades, lower interest payments on trillions in government debt, represents an enormous fiscal advantage. Structural advantage 3, the financial exclusion mechanism. In my view, this is the advantage that receives the least analytical attention, and it is the one that makes the petrodollar's geopolitical significance most concrete. Because the US dollar is the dominant currency for international transactions globally, not just oil, but also commodities, shipping contracts, international loans, trade finance, a large proportion of international financial transactions pass through dollar clearing infrastructure at some point. Dollar clearing means the transaction passes through a U.S. bank, a U.S. correspondent banking relationship, or through financial messaging systems that operate under U.S. legal jurisdiction. This gives the United States government a lever of significant practical power, the ability to exclude a country from dollar-denominated financial infrastructure. If a country is excluded from dollar clearing systems, its banks cannot process international transactions in the world's dominant commercial currency. If a country is excluded from the SWIFT financial messaging network, which the US has significant institutional influence over, its banks lose the ability to communicate internationally with other financial institutions for transaction settlement. The practical effect is a severe disruption of that country's ability to conduct international trade, pay for imports, receive export revenues, and service foreign currency debt obligations. This is what financial sanctions actually are at the mechanical level. They are an exercise of the leverage that dollar dominance in global transactions creates. This power flows directly from the petrodollar architecture. It is a consequence of the system, not a separate policy instrument. Think about what that actually means. The ability to significantly disrupt another nation's economy without deploying military force, that capability exists because of the financial architecture built through the 1973 arrangement and the decades of dollar dominance it sustained. Now, those are the three structural advantages the petrodollar system created for the United States on the demand side. The other half of the mechanical picture is what happens to the dollars on the supply side in the hands of the oil-producing nations who are earning them. This is called Petrodollar Recycling, and it is the mechanism that closes the feedback loop. Oil-producing nations earn their revenues in US dollars. That is the foundational rule we established. Saudi Arabia, the UAE, Kuwait, Iraq, Nigeria, and other major producers are continuously accumulating dollar revenues from their oil exports. The question is, what do they do with hundreds of billions of dollars in annual oil revenues? They cannot simply store physical currency. The logistics are impractical, and the holding cost would be enormous. They need to invest those dollar revenues in assets that preserve their value, generate returns, and remain accessible when the capital is needed. And here is where the loop closes. The asset class that oil-producing nations have historically directed the largest portion of their dollar revenues into is US government securities, treasury bonds, and treasury bills. The reasoning behind this choice is straightforwardly rational. US treasuries offer the deepest market liquidity on Earth, meaning oil-producing nations can buy and sell them in the enormous volumes their revenues require without significantly moving market prices. US treasuries are denominated in dollars, the same currency in which oil revenues are received, eliminating currency conversion costs and exchange rate risk for the core reserve position. US treasuries operate under US legal jurisdiction, providing strong legal protections for the assets. And US treasuries offer a rate of return consistent with a sovereign-backed instrument, while maintaining the liquidity profile required for a national reserve asset. Beyond US treasuries, Petrodollar Recycling has historically also directed significant capital into US equities, US real estate, US private equity, and other US financial assets. The sovereign wealth funds of major Gulf oil-producing nations, the Abu Dhabi Investment Authority, the Kuwait Investment Authority, the Saudi Public Investment Fund, represent institutional vehicles specifically designed to manage this recycled petrodollar capital. Now look at the complete loop. Oil-importing nations purchase oil in dollars, which creates dollar demand and supports dollar value. Oil-producing nations earn dollars, which they recycle into US Treasury bonds and US financial assets. The demand for US Treasuries from recycled petrodollar capital suppresses US government borrowing costs. Lower borrowing costs support US government spending capacity and overall economic stability. A stable, large US economy with manageable borrowing costs sustains confidence in the dollar as the global reserve currency. And a credible global reserve currency is the currency in which oil contracts are denominated. The loop is complete. Every stage feeds the next. In my view, petrodollar recycling is one of the most elegant, self-reinforcing financial mechanisms ever constructed. Not by design in the sense of a single architect drawing it on a blueprint, but as the emergent consequence of rational decisions made by multiple actors pursuing their individual interests simultaneously. And this is the structural reason the United States has been able to run persistent trade deficits across decades without experiencing the currency collapse that economic theory would predict for any other nation operating under comparable conditions. Every other country that runs persistent trade deficits, importing more than it exports year after year, eventually faces currency depreciation as the supply of its currency in global markets increases relative to demand. The petrodollar recycling loop creates a structural demand for US dollars and US financial assets that partially offsets the normal currency depreciation pressure from trade deficits. No other country on Earth has access to this mechanism. It is architecturally specific to the currency in which oil is priced. This is the part that changes everything about how you read US fiscal data. When you see US trade deficit figures and wonder why the dollar has not weakened proportionally, this loop is a significant part of the explanation. The petrodollar system's structural advantages for the United States have a mirror image: structural pressures on economies that are outside the loop. Let's be specific about what being outside the loop means in practice. Consider a developing economy, a country with a growing industrial sector, a currency that is not a major reserve currency, and significant oil import requirements. This country earns its export revenues in its own domestic currency, or in the currencies of its trading partners. To purchase oil, it must acquire US dollars, which means it must sell its own currency and buy dollars in foreign exchange markets. If the dollar strengthens relative to that country's currency, which the petrodollar demand floor structurally supports, then the cost of importing oil in local currency terms increases, even if the dollar price of oil remains constant. This means oil price inflation in developing economies is partially determined not just by global oil supply and demand, but by the strength of the US dollar relative to local currencies. Dollar-denominated debt creates a second layer of exposure. Many developing economies have borrowed in US dollars because dollar-denominated debt historically offered lower interest rates and broader access to international capital markets. When those debts require servicing, interest payments, and principal repayments, the borrowing nation must acquire dollars to make those payments. If their domestic currency has weakened against the dollar, the local currency cost of servicing that dollar debt increases, sometimes significantly. The 1997 Asian financial crisis, the 1998 Russian financial crisis, and numerous debt crises across Latin America, Africa, and Southeast Asia share a common structural feature: dollar-denominated debt obligations combined with domestic currency depreciation. The petrodollar system is not the sole cause of these dynamics, but its role in creating persistent structural demand for the dollar, which supports dollar strength against developing economy currencies, is a contributing factor worth understanding precisely. So, the complete mechanical picture of the petrodollar system is this: structural dollar demand on the import side, petrodollar recycling on the export side, three compounding structural advantages for the United States, and structural currency and debt pressures on economies outside the dollar loop. That is the machine. Now let's look at the political organization that sits at the supply side center of it. The Organization of the Petroleum Exporting Countries, OPEC, was founded in September 1960 at a conference in Baghdad. The 5 founding members were Iran, Iraq, Kuwait, Saudi Arabia, and Venezuela. The organization has expanded significantly since its founding and currently includes members across the Middle East, Africa, and Latin America. OPEC's core function is the coordination of oil production policies among its member nations, with the stated objective of stabilizing oil markets and ensuring fair and stable prices for petroleum producers. In practical terms, this means OPEC sets production quotas, specific volumes that each member nation agrees to produce, with the intent of influencing global oil supply levels and, consequently, global oil prices. When OPEC reduces collective production quotas, cutting the volume of oil its members collectively supply to global markets, basic supply and demand mechanics mean that if demand remains relatively constant, prices increase. When OPEC increases production quotas, supply increases, and prices face downward pressure. The scale of OPEC's collective influence on global supply is significant. The organization and its associated partners collectively account for a substantial share of global oil production, giving coordinated production decisions genuine market impact. Now, here is the precise mechanical connection between OPEC's production decisions and the petrodollar system specifically. When OPEC reduces production and oil prices rise, every oil importing nation needs to spend more dollars to purchase the same physical volume of oil. More dollars spent on oil means more dollar demand generated, because oil must be purchased in dollars regardless of price level. So OPEC production cuts, by raising oil prices, mechanically increase the quantity of dollars that oil importing nations must acquire, which supports dollar demand at the global level. This is a mechanical consequence of the pricing convention established in 1973. It is not a coordinated strategy between OPEC and the US government. It is simply what happens when you combine pricing in dollars with price increases driven by supply reductions. And this is directly connected to what we need to examine next, which is the internal complexity within OPEC that simplified narratives consistently miss. The media coverage of OPEC tends to present it as a unified actor with a single strategic posture, a bloc of oil-producing nations with shared interests and coordinated objectives. In my view, that presentation is analytically imprecise, and the imprecision matters when you are trying to understand whether and how the petrodollar system's foundations might change over time. OPEC is not a monolithic bloc. Its member nations have fundamentally different relationships with the dollar pricing system, different geopolitical exposures, and genuinely different incentive structures that produce different preferences regarding dollar dependency. Let me be specific. Saudi Arabia, the UAE, and Kuwait sit at one end of the spectrum within OPEC. These nations have deep, long-standing financial and security relationships with the United States. Saudi Arabia's sovereign wealth fund, the Public Investment Fund, holds substantial assets in U.S. financial markets. The UAE's financial infrastructure in Abu Dhabi and Dubai has extensive integration with dollar-denominated global capital markets. Kuwait's investment authority, one of the world's oldest sovereign wealth funds, has historically maintained significant allocations to U.S. and Western financial assets. For these nations, the dollar pricing convention is not merely tolerated, it is operationally embedded in their financial infrastructure at the institutional level. The alternative to dollar oil pricing for these nations would require rebuilding substantial financial infrastructure, renegotiating contracts, and potentially straining relationships with the United States that provide them with security guarantees in a volatile region. The calculus for these members is not anti-dollar. The existing arrangement delivers tangible benefits that matter to their national interests. Iran and Venezuela occupy a fundamentally different position within OPEC. Both nations have been subject to comprehensive US-led economic sanctions for extended periods. Under active sanctions, dollar-denominated transactions are effectively blocked, which means their oil revenues cannot flow through normal dollar clearing infrastructure, regardless of their preferences. For these nations, reducing dollar dependency is not an ideological choice, it is an operational necessity imposed by the sanctions architecture. They have been conducting whatever trade they can manage through alternative currency arrangements and informal channels out of practical requirement, not strategic preference. The irony here is worth noting precisely. Sanctions policy, designed to apply economic pressure on these nations for specific behaviors, has also functioned as an involuntary test of whether oil trade outside the dollar system is operationally feasible at any scale. The broader OPEC membership sits between these poles, nations with varying degrees of dollar dependency, varying security relationships with the United States, and varying practical capabilities to shift transaction currencies even if they wish to. Nigeria, Algeria, Libya, Gabon. These nations in most cases have neither the institutional infrastructure nor the political incentive to lead any departure from dollar oil pricing. Their export revenues are received in dollars, their sovereign debts are frequently denominated in dollars, and their financial systems are integrated with dollar-denominated global capital markets. Shifting away too fast from dollar pricing would create immediate practical disruptions for their own financial systems, not just for the United States. The honest picture of OPEC and the dollar is this. The organization contains members for whom dollar oil pricing is an embedded operational preference, members for whom it is an externally imposed constraint, and members for whom it is simply the path of least operational resistance. That internal complexity is the real analytical picture, and it is what makes honest assessment of OPEC's future relationship with the petrodollar system genuinely uncertain rather than neatly predictable in either direction. Here is what most people miss when they analyze OPEC in the context of the petrodollar. The question is not whether OPEC as an organization will decide to abandon dollar pricing. OPEC does not make collective decisions about pricing currency. Individual member nations make decisions about what currencies they accept for their specific bilateral transactions. The question is whether enough individual members, particularly those with the volume and influence to create meaningful precedent, will find sufficient operational incentive to diversify away from dollar-denominated transactions in specific trading relationships. Which brings us directly to the most analytically significant current development in the petrodollar system. And here is where it gets genuinely interesting. China is currently Saudi Arabia's largest oil export customer by volume. That single fact is the foundational context for understanding the Saudi-China yuan oil discussions, and it is the context that most of the coverage conveniently omits. Let's establish the basic commercial picture. China's industrial economy is one of the largest oil consumers on Earth. Saudi Arabia exports a substantial portion of its production to Chinese buyers, both state-owned energy companies and private sector refiners. From a straightforward commercial perspective, Saudi Arabia's largest customer wants to pay for its purchases in its own domestic currency, the Chinese yuan. This is not a geopolitical manifesto. It is a commercial preference. A large buyer wanting to transact in its own currency rather than acquiring a third currency, the US dollar, for the purpose of paying a supplier, is a rational preference that any business in any industry would understand. The question is whether Saudi Arabia has sufficient incentive to accommodate that preference. And this is where the analysis becomes more layered. Saudi Arabia began publicly discussing the acceptance of yuan-denominated payments for some oil shipments to China in the period following 2022. The discussions were confirmed in reporting by major financial publications, citing sources within the Saudi government and financial sector. So the question worth examining carefully is, what does this actually represent structurally? There are two distinct dimensions to the answer, and conflating them produces analytical errors in either direction. Dimension 1, the political signal. Saudi Arabia publicly discussing yuan oil pricing is a message to the United States government. The message is specific and legible. The US-Saudi security relationship that underpins the 1973 arrangement is not unconditional, and Saudi Arabia's strategic interests include maintaining productive relationships with major powers other than the United States. This signal is real. It is on the public record. It is geopolitically meaningful. The US-Saudi relationship has faced friction across multiple US administrations over various policy disagreements, including energy production levels, regional security commitments, and other bilateral issues. Saudi Arabia is communicating that it has strategic options and that the 1973 arrangement requires active maintenance from both sides, not simply assumed continuity. That signal matters. It is worth taking seriously as an indicator of how the relationship is evolving. Dimension 2, the financial reality. The actual volume of yuan-denominated oil transactions as a proportion of total Saudi Arabia oil export revenues remains, as of the most recently available trade settlement data, a small fraction of total volumes. The vast majority of Saudi Arabia's oil exports, and global oil exports broadly, continue to be priced, contracted, and settled in US dollars. The yuan-denominated transaction volumes, while growing in specific bilateral corridors, have not yet reached a scale that represents a fundamental shift in the architecture of global oil pricing. The politically charged rhetoric suggesting the petrodollar's end is real and significant. However, the actual financial transaction volumes supporting this are currently limited. The gap between this political signal and the financial reality is the source of genuine uncertainty. Framing the Saudi-China discussions as definitive evidence that the petrodollar system is ending is analytically imprecise. The current transaction data simply does not support that conclusion. Conversely, dismissing these discussions as irrelevant is equally imprecise. A political signal from the world's largest oil exporter about its relationship with the dollar pricing convention is not insignificant. While the direction of this signal is observable, the pace of any structural change and its ultimate destination are genuinely uncertain. Anyone claiming confidence in those outcomes is not offering an honest analysis. To summarize, we have covered the petrodollar's origins, its complete mechanics, the OPEC dynamics, and the specific Saudi-China dimensions. The final piece of the picture is the full geopolitical consequence architecture. That is what we will explore in the next chapter, the geopolitical consequences. Everything we have covered so far, from the origin story and mechanics to the recycling loop and OPEC dynamics, has been building toward this critical section on geopolitical impact. The petrodollar system is not merely a financial arrangement. It is, in fact, a geopolitical instrument of the first order, embodying power, influence, and control. To understand how it functions as a geopolitical instrument, we will examine three distinct dimensions: the sanctions architecture, the military correlation, and the BRICS context. Let us begin with sanctions, as this is where the petrodollar's practical power becomes most concrete and visible in daily headlines. Most people know that economic sanctions are a tool governments use to apply pressure on other nations or entities. However, what is less understood is the precise mechanical architecture that makes US-led sanctions significantly more powerful than those applied by other major economies. The answer lies primarily in the dollar's dominant role in global financial infrastructure, a role the petrodollar system sustained and deepened over 5 decades. Let's build the architecture layer by layer. Layer 1 is SWIFT. SWIFT stands for the Society for Worldwide Interbank Financial Telecommunication. It is a global financial messaging network, the technical infrastructure through which banks communicate for international transactions. For example, when a company in Germany pays a supplier in Japan, that transaction is coordinated through SWIFT messaging. International debt service payments flow through SWIFT. When a commodity trader settles an oil purchase, the settlement messaging passes through SWIFT. SWIFT processes millions of messages daily across over 200 countries, connecting more than 11,000 financial institutions globally. It is, in practical terms, the communications backbone of international commerce. The United States has significant institutional influence over SWIFT, thanks to its dominant position in global dollar-denominated finance and its regulatory jurisdiction. When the US and its allies exclude a country's financial institutions from SWIFT, they lose the ability to communicate with the global financial system for transaction settlement. They cannot receive or make international payments, severely disrupting their participation in global commerce at the messaging infrastructure level. But SWIFT exclusion is only the first layer. Layer 2 is dollar clearing. Here is what most analysis of sanctions misses, and it is one of the most important mechanical details. Even for transactions between two parties that have no direct relationship with the United States, say a Turkish company paying a Brazilian supplier, if that transaction is denominated in US dollars, it will at some point pass through a US correspondent bank for clearing. Dollar clearing is the process by which dollar-denominated transactions are settled through the US banking system, specifically through financial institutions that hold accounts at the Federal Reserve Bank of New York. This means the United States has a degree of jurisdiction over dollar-denominated transactions globally, not just transactions involving US entities or conducted within US territory. When the US Treasury's Office of Foreign Assets Control, OFAC, designates an entity as sanctioned, US financial institutions are prohibited from processing transactions involving that entity. And because major international banks rely on their US correspondent banking relationships for dollar clearing access, they typically comply with US sanctions designations for transactions well beyond US borders to preserve their access to the US financial system. The practical result? US sanctions have a global reach that extends far beyond the formal territorial jurisdiction of US law, because dollar dominance in global transaction infrastructure gives US regulatory decisions de facto global effect. This is the architecture that the petrodollar system built and sustained across 50 years. The dollar's dominance in oil pricing created global dollar demand. Global dollar demand drove global dollar usage for trade beyond oil. Global dollar usage for trade embedded dollar clearing infrastructure at the center of international finance. dollar clearing infrastructure gave U.S. regulatory decisions global reach. Each step follows from the previous one. The sanctions power is a direct architectural consequence. In my view, this is the most concrete demonstration of what the petrodollar arrangement actually produces at the geopolitical level. The ability to apply significant economic pressure on another nation's economy without deploying military force is a direct product of the financial architecture built through the 1973 arrangement and the decades of dollar infrastructure development it enabled. Layer 3. Secondary sanctions. Secondary sanctions are restrictions applied not to the primary target nation, but to third-party entities, companies, banks, or governments in other countries that continue doing business with the sanctioned nation. The mechanism is direct. If a third country bank continues processing transactions for a sanctioned entity, the US government threatens to restrict that bank's own access to dollar clearing infrastructure. For most international banks, this threat carries significant weight. Losing dollar clearing access would mean losing the ability to process dollar-denominated transactions globally, which for most major banks represents a substantial portion of their international business volume. The result is that U.S. secondary sanctions effectively extend U.S. regulatory reach into the domestic business decisions of financial institutions in countries that have not themselves agreed to the sanctions, creating a compliance architecture with global scope. And this compliance architecture exists because of dollar dominance, which exists because of petrodollar demand, which exists because of the 1973 arrangement. So, the three layers of the sanctions architecture, swift exclusion, dollar clearing jurisdiction, and secondary sanctions, are all products of the same underlying system we have been analyzing throughout this video. Understanding the petrodollar is not academic background knowledge. It is the foundational context for understanding how global financial power actually operates in practice. The second geopolitical dimension requires a specific framing before we cover it, because this is an area where the analytical record needs to be presented carefully and precisely. The historical record shows a correlation between U.S. military presence and security commitments in oil-producing regions, particularly the Persian Gulf, and U.S. interests in maintaining stable oil supply and petrodollar arrangements. The 1973 arrangement between the U.S. and Saudi Arabia explicitly included a military protection component. U.S. arms sales and security guarantees were a stated part of the original deal. U.S. military infrastructure in the Gulf region expanded significantly in the decades following 1973, with naval presence, air bases, and security partnerships with Gulf Cooperation Council nations developing into a substantial regional military footprint. The Gulf War of 1990 to 1991, in which a U.S.-led coalition intervened militarily to reverse Iraq's invasion of Kuwait, protected the oil production and export infrastructure of a major Gulf oil-producing nation, and restored access to Kuwaiti oil revenues within the petrodollar framework. These are historical facts on the public record. What responsible analysis requires is the following distinction. Noting a correlation between U.S. military presence in oil-producing regions and U.S. interests in petrodollar stability is not the same as claiming that every U.S. foreign policy decision in the Middle East is primarily motivated by petrodollar preservation. Multiple factors drive U.S. foreign policy decisions in any region: strategic, humanitarian, alliance-related, and domestic political factors all play roles. The petrodollar interest is one input into a complex foreign policy calculus, not a single deterministic explanation for all outcomes. With that distinction clearly stated, the correlation between U.S. security commitments to oil-producing nations and the petrodollar arrangement those nations anchor is a real feature of the post-1973 geopolitical landscape that any complete analysis of the system must acknowledge. The 1973 arrangement was not just a financial deal, it was a security arrangement with financial consequences, and the security dimension has been maintained and developed across 50 years in parallel with the financial one. The final dimension of the geopolitical architecture is the BRICS framework, and this requires the same analytical precision we applied to the Saudi-China discussions. BRICS is a grouping of major emerging economies, originally Brazil, Russia, India, China, and South Africa, that has expanded its membership in recent years to include additional nations. The grouping operates through summits, declarations, and bilateral and multilateral cooperation arrangements among member states. One of the stated objectives of BRICS, articulated across multiple summit declarations, is reducing dependence on dollar-dominated financial systems in global trade and investment. What does this look like in practice? In practice, BRICS-aligned nations have pursued dollar reduction in specific, targeted corridors where the political incentive is sufficient and an operational alternative is available. Bilateral trade settlement in local currencies, Indian rupees for specific trade flows, Chinese yuan for others, has increased among BRICS members and their trading partners in certain corridors. China has developed the Cross-Border Interbank Payment System, CIPS, as an alternative messaging infrastructure for yuan-denominated transactions. Its current transaction volumes are significantly smaller than SWIFT's, but its development represents a long-term infrastructural investment that is worth tracking. Russia has accelerated the development of its own domestic financial messaging system, SPFS, as an alternative to SWIFT for domestic and some international transactions. These developments are real and worth tracking carefully. And here is the honest assessment. What the data currently shows is selective dollar reduction in specific bilateral corridors, primarily where political incentives make dollar alternatives operationally necessary or strategically attractive. What the data does not currently show is a coordinated, large-scale replacement architecture for dollar-denominated global trade at anything approaching the scale of the existing petrodollar system. The dollar's share of global foreign exchange reserves, global trade invoice currency, and global financial transaction settlement remains substantial, as confirmed in Bank for International Settlements and IMF published data. The accumulated infrastructure of the existing system, the contracts, the hedging instruments, the correspondent banking relationships, the legal frameworks, the pricing conventions, all of this represents institutional inertia that cannot be replaced quickly, regardless of political preference. Switching currencies in global commodity markets is not a simple operational decision. It requires rebuilding the contract standards, the hedging infrastructure, the settlement systems, the legal dispute resolution frameworks, and the liquidity pools that make large-scale commodity trading operationally feasible. None of those components currently exist in yuan or any other currency at the scale required to handle global oil trade volumes. So the honest picture of the BRICS challenge to petrodollar dominance is this. The political intent is on the public record and real. The directional trend toward greater local currency trade settlement is observable. The pace is gradual and measured by years and decades rather than months. And the ultimate destination remains a question of genuine uncertainty rather than settled analytical conclusion. And here is what most people miss in the coverage of this topic. A gradual, multi-decade reduction in dollar dominance in specific trade corridors is not the same thing as the end of the petrodollar system. These are different claims at different magnitudes, and conflating them produces systematically misleading analysis. So the question becomes, what does honest structural analysis actually tell us about where the petrodollar system stands? That is what we build out now. We have covered significant ground in this video. We started with why oil is the foundational cost base for the global economy, not primarily an energy commodity, but a manufacturing and logistics input that touches every physical product traded on Earth. We traced the architecture from Bretton Woods in 1944 through the Triffin dilemma and the structural contradictions of the gold-backed system, through the Nixon shock in 1971 and the crisis it created, to the 1973 oil embargo and the Kissinger-Saudi negotiations that produced the petrodollar arrangement. We built the complete mechanical picture of the petrodollar feedback loop, the structural dollar demand it creates, the the three compounding advantages it delivers to the United States, and the Petrodollar Recycling mechanism that closes the loop and makes it self-sustaining. We examined OPEC's internal complexity, the genuine diversity of incentive structures within the organization that the monolithic narrative consistently misrepresents. We analyzed the Saudi-China yuan discussions with the precision they require. The political signal is real and on the record. The transaction volumes are currently limited. The gap between those two facts is where honest uncertainty lives. And we built the complete sanctions architecture from the ground up, showing exactly how swift exclusion, dollar clearing jurisdiction, and secondary sanctions all derive their power from the same foundational petrodollar system. So what does all of this add up to? Here is my honest structural assessment. The petrodollar system was built through three sequential decisions across a 30-year period. The Bretton Woods Conference in 1944 established dollar reserve currency status. The Nixon shock in 1971 severed the gold anchor and created the conditions requiring a replacement. And the 1973 Kissinger-Saudi arrangement provided that replacement by anchoring dollar demand in oil pricing. Each step in that sequence was a rational decision by actors pursuing identifiable national interests under specific historical pressures. The system that emerged from those decisions has produced 5 decades of dollar dominance in global finance, not because the United States imposed it by force, but because the feedback loops it created aligned the rational self-interest of enough participants to sustain it. Oil importing nations hold dollars because they need them for oil. Oil exporting nations recycle dollars into U.S. assets because U.S. financial markets offer unmatched depth and liquidity. The U.S. government borrows at lower costs because petrodollar recycling creates persistent demand for its bonds. Dollar dominance in financial infrastructure gives U.S. regulatory decisions global reach. And all of these dynamics feed each other in the loop we built earlier. The question most relevant to a serious observer of this system is not whether the petrodollar will end in the near term. The current data does not support that conclusion. The question is whether the conditions that sustain the system are stable, and whether the incentive calculations of the key participants are shifting. And here is what the observable data on this actually shows. The Saudi-China discussions indicate that Saudi Arabia is actively managing its strategic relationships beyond the exclusive US-Saudi framework of 1973. That is a real and on-the-record shift in the diplomatic posture of the system's most important anchor. The development of alternative transaction infrastructure, CIPS, SPFS, bilateral currency swap arrangements, indicates that multiple large economies are investing in the technical capacity for non-dollar trade settlement. Infrastructure investment precedes behavioral change. The expansion of BRICS membership indicates growing political coordination around the objective of reducing dollar dependency, even if the current transaction data shows limited practical progress toward that objective. These are observable trends. They are worth tracking carefully and analyzing precisely. And the honest answer is, the direction is observable in the data. The pace is genuinely uncertain. The ultimate destination, whether this represents a gradual reduction in dollar dominance within a still dollar-centric system, or the early stages of a more fundamental architectural shift over decades, is a question that even sophisticated institutional analysts disagree on. Anyone presenting that outcome with certainty is not giving you honest analysis. What the evidence is clear on is this: understanding the petrodollar system, its origins, its mechanics, its geopolitical consequences, is not optional background knowledge for anyone trying to understand how the global economy actually operates. Every major sanctions headline, every OPEC production decision, every central bank reserve allocation report, every sovereign wealth fund investment announcement, every discussion about alternative payment systems, all of these are components of the same system we have built from the ground up in this video. This is not a political argument. It is a structural one. And this is not financial advice. It is financial education. The distinction matters because structural understanding is what allows you to read events as they unfold with the analytical framework required to assess what is actually significant and what is noise. That is what this video was built to provide. If you watched this video from the beginning, you now have a complete structural understanding of the petrodollar system, from its architectural origins in 1944 through its full mechanical operation, through the OPEC and Saudi China dimensions, to the honest assessment of where the geopolitical landscape stands. Most people encounter the word petrodollar and get a two-sentence definition. You now have the complete picture, every layer of it, built from first principles. If this level of structural analysis of how the global monetary system operates is something you want to go significantly deeper on, I made a complete course titled Applied Macroeconomics. It covers the full architecture of the global monetary system across 10 modules, from the theoretical foundations of money and central banking mechanics through sovereign debt, international trade theory, economic cycles, and the future of monetary architecture. Total course video content is over 2 hours, intentionally stripped of all filler. Every module is there because it delivers genuine analytical value. Email support is included. Any questions you have while working through the material can be addressed directly. The link is in the description below. Now, since you stayed until the end of this video, it tells me you are genuinely serious about understanding how global finance actually works, not just the surface level version. There are 2 videos appearing on your screen right now that go into equally detailed territory on related topics that connect directly to what we covered here. If you found the petrodollar system valuable to understand, those videos will build your analytical framework further. Hit subscribe if you want to see more content built at this level of depth and precision. And if this video delivered genuine value, a like takes 3 seconds, and it tells the algorithm that this kind of rigorous financial analysis is what people actually want to watch. Thanks for watching.